Preparing for a financial analyst at Heineken interview? You've reached Candy Mentor, and this video is for you. We'll walk through 15 key questions you're likely to face. For each question, you'll see a sample answer followed by the key points to cover. Subscribe, like, and share, and drop a topic request in the comments. Question 1. Walk me through the 3 financial statements and how they connect. An income statement explains profitability over a period. I would start with revenue, then subtract cost of goods sold to reach gross profit, followed by operating expenses, EBIT, finance costs, taxes, and net income. For Heineken, I would connect each line to drivers such as volumes, pricing, mix, input costs, marketing investment, and currency. I would also distinguish accounting profit from cash generation, then reconcile earnings with working capital and capital expenditure. While answering, focus on the income statement, balance sheet, and cash flow statement, their linkages through net income and retained earnings, and how working capital, depreciation, and capital expenditure affect reported performance. Question 2. Why do you want to become a financial analyst at Heineken? Heineken appeals to me because it combines a global footprint with a highly local, consumer-driven business. A financial analyst can influence decisions on pricing, promotions, product mix, investment, and cost control rather than simply report historical results. I am particularly attracted to the balance between recurring brand strength and market-specific challenges, including inflation and currency. My strengths in analysis, communication, and turning data into practical recommendations fit that environment well. Make sure to cover Heineken's global scale, consumer-facing business model, exposure to commercial drivers, interest in business partnering, and how your analytical skills can support profitable growth and disciplined decision-making. Question 3. How would you analyze a revenue miss versus budget at Heineken? I would bridge the variance rather than label it simply as underperformance. First, I would separate volume, price, mix, foreign exchange, and timing effects by market and channel. Then I would test whether lower volumes reflected distribution, competition, whether stock availability, or promotional execution. I would discuss findings with commercial teams, quantify the profit impact, and update the forecast. The recommendation might combine targeted pricing, stronger execution, or revised spending, depending on the evidence. In your answer, talk about decomposing revenue into volume, price, mix, geography, channel, and currency, comparing actuals with budget and prior year, identifying root causes, and proposing commercially actionable responses. Question 4. What is the difference between gross margin, operating margin, and EBITDA margin? Gross margin is gross profit divided by revenue, showing the economics after product costs. Operating margin divides EBIT by revenue and includes operating expenses such as marketing, distribution, and administration. EBITDA margin adds back depreciation and amortization, providing a view before those non-cash charges. I would use all 3 together. Gross margin highlights pricing and input cost pressure, operating margin reflects spending discipline, and EBITDA supports comparisons of operating cash-generating capacity with appropriate caution. Be sure to mention each metric's numerator, the expenses included or excluded, how analysts use margins to assess efficiency, and why comparisons require consistent accounting policies, business mix, and reporting periods. Question 5. How would you build a forecast for a beer market or brand portfolio? I would build the forecast from operating drivers rather than apply a blanket growth rate. For each market or brand, I would estimate volume using category growth, market share, distribution, seasonality, and promotional activity. I would then layer price, pack, and channel mix, excise taxes, input costs, logistics, marketing, and currency. I would create base, upside, and downside cases, document assumptions, compare them with external data, and review them regularly with sales and marketing teams. Focus on a driver-based approach using volume, price, mix, market share, distribution, seasonality, promotions, costs, exchange rates, and scenarios, while explaining how you would validate assumptions with commercial stakeholders. Question 6. Explain how inflation in commodities and packaging could affect Heineken's profitability. Higher prices for barley, aluminum, glass, energy, or transport would raise cost per hectoliter and compress gross margin if pricing does not keep pace. I would quantify the exposure by input, geography, contract timing, and hedge position. Management could respond through pricing, pack size changes, procurement, productivity, and selective premiumization. However, I would stress test volume and mix effects because aggressive price increases can reduce demand or encourage consumers to trade down. Make sure to cover key inputs: cost per hectoliter, gross margin pressure, pricing and productivity responses, timing lags, hedging limitations, and the risk that consumers trade down or volumes weaken after price increases. Question 7. How would you explain a favorable EBITDA variance that does not translate into cash flow? EBITDA excludes several cash and non-operating effects, so a favorable variance is not automatically a cash benefit. I would reconcile EBITDA to operating cash flow by checking receivables, inventory, payables, provisions, taxes, and interest. I would then review capital expenditure, lease payments, acquisitions, and foreign exchange movements to reach free cash flow. For example, inventory built ahead of a peak season could support future sales while temporarily absorbing cash and weakening the conversion rate. In your answer, discuss working capital movements, provisions, taxes, interest, capital expenditure, foreign exchange, acquisitions, and timing differences, then explain how you would reconcile EBITDA to operating and free cash flow. Question 8. What working capital metrics would you monitor and why? I would monitor receivable days, inventory days, payable days, and the resulting cash conversion cycle. For Heineken, inventory analysis should distinguish raw materials, packaging, finished goods, and seasonal stock, while receivables should be segmented by customer and aging. I would investigate unusual movements against sales and production plans, not pursue lower balances blindly. Extending supplier terms may improve cash, but I would consider supplier relationships and service continuity before recommending it. Mention days sales outstanding, inventory days, days payable outstanding, cash conversion cycle, overdue receivables, stock obsolescence, supplier terms, and trade-offs between liquidity, service levels, and operational resilience. Question 9. How would you evaluate whether a promotional campaign was financially successful? I would compare campaign results with a credible baseline, ideally using control markets, comparable periods, or pre-campaign trends. I would measure incremental volume, realized net revenue, trade spend, discounts, cannibalization, and contribution margin rather than headline sales alone. I would also assess retailer inventory and repeat purchases to separate forward buying from genuine demand. A successful promotion should deliver attractive incremental profit or strategic brand benefits, not merely shift timing. Focus on incremental volume and revenue, baseline sales, trade spending, cannibalization, gross-to-net effects, contribution margin, retailer inventory, repeat purchase, and whether the campaign created sustainable brand or market share benefits. Question 10. How would you assess the financial impact of a price increase? I would model the increase by customer, channel, pack, and market, then estimate volume elasticity and competitor reactions. The key calculation is incremental price contribution less any lost volume, mix deterioration, additional discounts, or trade investment. I would also test timing, consumer affordability, and whether premium products offer a better route than broad increases. Finally, I would present base, downside, and upside scenarios, including the effect on revenue, gross profit, market share, and cash. Be sure to mention price elasticity, volume loss, mix, competitor responses, channel differences, gross-to-net revenue, margin per unit, customer negotiations, and scenario analysis before recommending implementation. Question 11. What is variance analysis, and how would you present it to a non-finance manager? Variance analysis explains why actual performance differs from a plan, forecast, or prior period. I would present a concise bridge showing the largest drivers such as volume, price, mix, input costs, marketing, or currency, then explain the operational cause behind each. With a non-finance manager, I would avoid accounting jargon and focus on decisions: what happened, whether it is temporary, who owns it, and what action can improve the next forecast. In your answer, explain actual versus budget and versus prior year analysis, favorable and unfavorable drivers, materiality, root cause questioning, clear visuals, and translating financial findings into operational actions. Question 12. How does foreign exchange affect Heineken's reported results? Foreign exchange affects Heineken through transaction exposure, such as imported inputs or foreign currency debt, and translation exposure when subsidiaries' results are converted into the reporting currency. I would separate reported growth from constant currency growth to identify underlying performance. I would also review hedges, their timing, and residual exposures. A weaker local currency can reduce reported revenue and profit even when the local business grows, so management needs both views for sound decisions. Make sure to cover transaction and translation exposure, local currency performance, reporting currency effects, constant currency analysis, hedging, sensitivity analysis, and why operational performance should be separated from exchange rate movements. Question 13. Describe a time you found an error in a financial analysis. In a monthly analysis, I noticed that a margin improvement looked inconsistent with the underlying cost data. I traced the formulas and found that one product group had been mapped to the wrong sales category, overstating the favorable mix effect. I checked the source file, quantified the correction, informed my manager promptly, and reran the analysis. I then added a mapping check and reasonableness test to the process, turning a mistake into a stronger control. Focus on the control or review process, how you identified the inconsistency, validation steps, communication style, correction, root cause prevention, and the lesson learned about accuracy and professional skepticism. Question 14. How would you prioritize competing requests from sales, supply chain, and senior management? I would rank requests by decision urgency, financial impact, risk, and dependencies. A forecast needed for a same-day pricing decision may take priority over a routine dashboard, while a regulatory or control issue would receive immediate attention. I would clarify the required output, provide an initial directional view when useful, and agree deadlines with stakeholders. Throughout, I would communicate trade-offs early and avoid sacrificing accuracy without clearly labeling assumptions and limitations. Talk about urgency, business impact, decision deadlines, data availability, dependencies, stakeholder alignment, transparent trade-offs, and maintaining quality while communicating realistic delivery expectations. Question 15. What would you do if your analysis contradicted a senior stakeholder's view? I would first verify the data, definitions, period, and assumptions to ensure the disagreement was genuine. Then I would present the analysis respectfully, separating observed facts from judgment and explaining the commercial implications. I might offer alternative scenarios if elasticity, timing, or market information remained uncertain. My goal would be constructive challenge, not winning an argument. If the decision ultimately differed from my recommendation, I would support it professionally while documenting key risks and follow-up metrics. Be sure to mention respectful challenge, checking data and assumptions, separating facts from interpretation, asking clarifying questions, presenting scenarios, documenting conclusions, and supporting the final decision once aligned. If you are still with us, congratulations, you are much ahead of the rest and serious about preparing for your interview. We hope we were able to add value to your preparation and create some helpful content. Do not forget to like and share this video. Your small act can do great things for us.